what's the portfolio's return? As you have studied, right, in the finance or in a investment course, right? Our portfolio's return RP, right, equal to what? Weight times return. Then do what? Then do the summations, right? So if you have the n asset in the portfolios, right? So each asset weight times return for this asset, right? Do the summation will be the portfolio's what? Total return, right? So if you want to expand the whole formula, will be W1 R1 plus W2 R2, then plus the other terms, right? That's for the portfolio's return. How about portfolio's risk? Portfolio's risk will be solved as the sigma p, right? Sigma also called standard deviations, right? So standard deviations is a measure of the risk. So how to solve a portfolio's risk? We will first solve the variance, right? Variance is the WI square, right? And what? And the sigma I square plus what? Plus the summation, right? Sigma I WI, right? And also rho is the correlation, right? WI plus 1 and sigma I plus 1, right? And be careful, right? This part, for any two assets in the portfolios, they have what? They have the correlations, right? So for each two assets, you will do the correlations and the covariance, right, in this part, right? So for example, if we have the, n assets, right? So how many terms will be for this part, right? Will be what? Will be for, C and 2, right? This is what? Combinations, right, in a econometrics, right? So n times n minus 1 over 2, right? So there are many terms, right, for this part, right? This one including n terms, right? But this one including n times n minus 1 over 2 terms, right? For convenience, right, we will not using this, one line formula to solve the portfolio's risk. We can also use our what? Our tables, right? You can do this one much easier, right, by using the tables, right? For example, how to solve the covariance, right, in this for this term, right, between France and what? Germany, right? So France and Germany will be in this what? In this part, right? Will be in this part, right? You see, in the horizontal row is the France, the vertical columns is Germany. So this is the risk, or you can see the covariance between what? France and Germany, right? This one will be solved. Use what? Use the weight of the France, right? Weight of France here, right? Times the risk of what? France, right? Or you can see the weight is also available here, right? So if you don't want to refer to very far here, right? Of course, you can get this weight directly in this row, right? So weight of France times the risk of France. Now we have the correlations, right, in these triangles, right? So we will also put the risk as a row, right, in this table, right? Times the weight of what? Weight of the Germany, right? Weight of the Germany, then times the risk of what? Germany. So this is the covariance between these two countries, right? So we can use our Excel sheet to automatically form this whole table for the covariance, right, between each two countries, right? And for the whole portfolio's risk, we will just easily do our summations, right? You can see we will first do our summations. That will be the variance, right? So the variance highlighted in the yellow will be the summation for all the tables, right, in these areas. After you solve the variance for the portfolios, then you will take a square root, right? It will be the portfolio's risk. So you solve what? You solve the variance, right? You solve the risk for the portfolios. Then we will continue to solve what? Sharp ratios, right? We mentioned in last class, right? Sharp ratios will be the portfolio's return. minus risk-free rate over what? Over sigma, right? So for the Excel sheet here, right, how to solve the Sharpe ratios, you can see the details, right, in these tables, right? We will use the return is here, right? Minus the risk-free rate is this one, right? So 1.722, right? Minus 0, right? And over what? Over sigma is a 4.208%, right? You solve this one. So that's our Sharpe ratio. But you know, initially, right, as a financial advisor, you actually not know how much you need to allocate to different countries' what asset, right? So these numbers should be not given, right? Not actually, should be specified in this column yet, right? After you do the analysis, you will determine what's the weight, right? But in these calculations, we assuming this weight is given, right? So how can you actually, determine the weight? Not, like here, right? Given these numbers directly. First, you can clear all these numbers, right? Then what's your goal to solve optimal portfolios will be what? Will be maximize what? Sharpe ratios, right? You want to maximize the Sharpe ratios for your clients, right? What's the Sharpe ratio means? For a certain risk, right? The clients take, you want to maximize what? The return, right? Return respectively. That's called what? Maximize the Sharpe ratios. How to maximize one goal, right? In Excel by operating columns or a cell. We use what? We use a solver, right? You can use the solver functions, right? Or you can just click this cell, right? This cell, then do what? You can see this one, right? This is the Sharpe ratios formula, right? So first we can click erase this one, right? Now we try to put a solver, right? Solver, if it's not directly given, you can use what? You can use the add-in, right? File, and then you can see what? You can see the options here, right? In options, you can add in what you want to do here, right? You can either add in any financial analysis, or you can add in what? Solver, right? So you can see the solver add in, right? And then you can go to what? Add in this solver, right? By choose this solver add in, right? And in your Excel sheet, you will have the solver available, right, for you to do what? To do the further analysis, right? So in the data, right, you will choose the solver. Then you set this one as your what? As your goal, right? As your objective, right? And you will choose what? To maximize this one by changing this column. After you press enter, right, the Excel will automatically generate what? This column, right, for this weight. Based on this weight, by generating from Excel, you can tell how much money you need to allocate, right, into different country what investment, right? For example, about half of the weight of your what? Of your portfolios you will allocate to what? To the US asset, right? Then next one will be what? Will be the Japanese market asset, right? For remaining monies will be split into what? France, Germany, and what? United Kingdom, right? There will be no allocation to it, to the Canadian, right? No allocation to the Switzerland, and also no allocation to the cash, right? You see, that's the meaningful, applications use the market weights portfolio optimizer and use our solver, right? Functions in Excel, right? So if you have never used the solver function before, maybe it is a time for you to use this one at home to see how can you optimize your investment portfolio, right? To allocate different proportion of the investment amount, right, into different country, right, to maximize the Sharpe ratio. This function is very useful, not just for this course. Many different courses, right, are using these solver functions. For example, in the accounting, right, we use the solver function to minimize the cost, right? To maximize what? The profit, right? You can use this one, right? In our corporate finance and also healthcare financial management, right? We use the solver functions right? To what? To reduce or minimize the cost of the capital, right? To maximize what? Net present value, right? So this is very useful function. So please try this one at home, right? So you can follow examples on our textbook, right, to get familiar with these solver functions. And also these examples provide you some examples for some application of our investment and international finance, right, in financial advising, right, in the real industry. Right? In the industry, we also use market-based portfolios, right? You know what? In the financial advising, right? How to, form an optimized portfolio for the investors, right? We have what? We have an optimal point, right? But for this optimized point, what's the weight of each stock or what's the weight of each country, right? I hope this one can give you some sense, right? You can say this is the risk and this is the what? Return, right? So this point give you an optimized point for a certain risk. This is the highest return you can touch, right, for your investment. So that's for the global portfolios case, right? I want to illustrate, right? So if you have any questions, let me know. I will post these tables, right, on our board, right, in a lecture notes folder, right? So please download and check this one, right, by yourself. So let me give you some feedback, right, for your homework, right, on Blackboard, right? I check most of you guys, homework. You are doing very well, right? But some students hadn't finished the Wall Street Journal article summary, right? So please do this one as soon as possible. As you know, next month is our final exam, right? So you want to finish this one before the due, right? I see some students, right, you not finished yet, right? But for more than 70% of students, you have finished these articles, right? So you can see your grade next Monday. But for students, you hadn't finished this Wall Street Journal summary article, please do this one as soon as possible, right? It's only 2 to 3 pages, right? Including the 3 articles, right? So please don't wait until next week, right, to do it, but you can do it earlier. So now let's go to our review. So first, let me show you something for our course website. Right? So even we finish this course, you can still use the materials, right? I post on our course website. Right? So first, I will show you guys, right, how to access our course website. So our courses are all on our website, right? In our Google site, right? So in the Google site, you can go to my course link. And I post the video, right, for some course on this Google site. And also all the lecture videos you can download from YouTube, right? So if you want to review, right, for some homework, right? And also if you want to review for some lectures, right, some discussions, you can basically go to the YouTube, right? Go to my YouTube channel, right? And under the link of the international finance, you can find most lectures, right, for this course available for you to watch and download. Okay. Now let me go to my course link, right, for this one. So our course called International Financial Management on our course website. Right, so let me copy, right, the link for you guys, right, to the chat. So if you want to go to the link, you can just directly, copy the link, right, to the IE, right? You can see the details for our course, right? Including some discussion we have done before, and also we study what triangular arbitrage, right, for the midterm test. So there's a detailed guidance, right, available on this link, right? So I hope you guys can check the link I just post on the chat. Right? If you cannot see the link, let me know. Right? And I also see you guys already, sign your name, right, in the chat for attendance. Right? If you hadn't done that, right, you can continue put your name. in the chat as the attendance. And you can see, let me share my screen with you guys. So this is the the website I'm displaying for you guys now, right? It's including all my teaching materials, right, for different course, right? So in the future, if you want to take some course in the investment, right, or corporate finance, all the other course, right? So I put all the materials, right, available on this website. And also you can see some data for the COVID-19, right? And also something for the investment outlook, right? And in these matters, when we study the international equity market, right, I give you some recommendations for stocks, right? In the last 2 weeks, right, some stocks performing very, very good, right? Especially for the vaccine companies, right? They increasing more than 40%, right, in the last 3 weeks, right? So if you happen purchase this stock, right, you may have a good return, right? Especially for Tesla, right? Also Zoom, right? This stock are surging quickly, right, in the last 2 weeks. If you hadn't purchased any stock before, right, maybe you can consider about that, right? Because for this year, right, the job market will be very tough, right? So maybe we can do some investment by ourselves, right, to do some either passive investment use the index, right, or maybe you can do some active investment by yourself, right? I hope you guys can get some return and realized, right, by yourself. It will help you to support your financial spendings, right? So here, let me show you something for this year's most recent report, right? This is from the Fidelities, right, for the international equity investment portfolios they have for the investors. But you can see how they allocate the money into what in the global portfolios, right? In their global portfolios, if you cannot see the screen, right, let me know. Right now, I display the report from the Fidelity companies. Right, you can see here, right, about 55% in the domestic equities, right, in the 45% in what in the rest of the world, right? So that's how they allocate money in different markets. So while they do global portfolios equities, because for the international equities, right, it will give you some benefits forward, geographic diversifications, and also more growth potential, right? More growth potential. Why? Because as we show in the examples in the Excel sheet, which two countries, right, in our example has the lowest correlations between the Japan and the US, right? So you can see eventually when we try to create optimal weight for these portfolios, we actually put more weight in what in the US and Japan, right? These two countries has the lowest correlations, right? It's confirmed if you put a country with a low correlations, right, you can reduce what the risk, but still maintain a good return. And also for some countries, emerging markets, right, they show a more what growth potential, right? So you can enjoy your global portfolios diversifications, right, to reduce risk, but also can have our growth potential, right? So that's why we have a global portfolios perspective, right? And you can see which country performing best. Actually, it's not the same country on different year, right? For example, on 2019, right, which country performed the best in the financial markets? Actually, it's what Russia, right? And the US performed the best on what? Only on 2013, right? But the other countries, for example, on 2018, right? Most countries has the financial markets go to a downside, right? But which ones still perform relatively better? Actually, is Brazil, right? Brazil's on 2016 even increasing by what? More than 60%, right? And also China performing better on 2017. So not every year, right? US performing the best among all the global competitors, right? Some years the other countries are performing better. Some years, right, US performing better. So why not you form portfolios, right? To form form a diversified investment, right, in different countries, right? To increase your to increase your potential for your investment goals. Right? So that's why we study global portfolio investment, right? And this time we experience pandemic of the coronavirus. Not every country recover in different pace, right? Some country recover sooner, right? Some country maybe because they are poor healthy care, right? Fundamentals, they may be taking more time to recovering, right? So when you do the financial investment across different countries, you want to pay attention to these situations, right? And also, like I mentioned, right, for your For your microwaves, microwaves efficient frontier, right? If you only invest in a domestic country, right, and this is your curve, right, called microwaves frontier, right? You can study this one in the investment course, right? And you can never beyond this area, right? This is frontier, right? So you can never beyond this frontier. However, with you adding assets from the global market, right, your whole opportunity set will be increasing, right? So your whole curve will be beyond the area you have for domestic market, right? So you can touch a higher point with the same risk you have taken before, right? So that's the benefits of global diversifications, right? The Harvard Business School have studied, global equities, right, for more than 20 years. They found, right, in the short term, right, maybe domestic market were performing better, right? However, if you put your money, right, for the long-term investment, right, and with exposure to the global market, you can enjoy low risk, but still maintain a relatively higher return, right? So that's the chapter 14 tells us about, right? So now we finish all the chapter for these matters, right? We will now go to review for our course. So if you have any questions for any topics, please type in the chat, or you can talk to me directly right in today's class. I would like to answer your questions for this final review. First, right, let me show you something. Something maybe you already, studied before, right? I just want to give you a remind, right? If you hadn't studied this part, right? So please do this one at home. And I say some students, right? If you have the questions about assignments, right? Let me know, because today I actually manually graded some students' assignments because they hand in their assignments later than due, right? So I manually graded your assignments, right? So you can check your grade all on the blackboard, right? So if you want to check the grade, go to blackboard, then open the grade on the blackboard in the grade center. In the grade center, you can see each assignment's grade, and also you will see the final exam grade there, right? So let me first close my Excel sheet. So let me click this one first. Okay, so now let me share the screen with you, right? For the some homework, right? Okay, so I see the Hamid, right? You raise the hand. What's your questions? So can we do any Wall Street Journal presentation today? Let me check. Can I share with you the screen I have? Let me check. Right. Advanced. Let me see the share. I think if you want to do a presentation, right, you want to have the authority with the sharing with the screen with me, right? But I don't see the the functions available right for my terminal. Can you see any screen sharing right on your side? If
Yeah,
you
Professor, I could share my screen.
oh sure, if you can share the screen, please do that. Can you
Yeah.
do that right now? Yeah, let
Uh,
me check.
yeah, I'm ready. I could do it right now if you want, Professor.
Yeah, sure.
All right, perfect.
Okay.
Oh, Professor, you have to you
Mhm.
disabled screen sharing for other people than the host.
Okay, so I will stop, sharing, right?
Oh, you could just Professor,
Mhm.
you could make somebody else the host. I think you could make up the participants the host, and then they could share the screen as well.
Oh, let me see here. More. Make host. Yeah, I change you to a host now.
All right, perfect.
Mhm. So you can share the screen if you want.
Yes. Do you see my screen, Professor?
Yeah, I see. I see. Oh, it's about the pandemic, right?
Yeah. So basically, I put all the three Wall Street Journal articles and I combined it into one presentation.
Okay, so these three articles you download by yourself or use the articles from from the papers on Blackboard.
Yes.
Oh, okay, I see.
Okay. Can I start, Professor?
Yeah, you can talk right now. Yeah.
All right, perfect. So hey everyone. So my presentation is on the pandemic, but it discusses the three articles that I've chosen. Discuss three different aspects of the effect that the coronavirus has had on the global economy. So let's start. So starting off with the global impact, the first article was titled "Coronavirus Concerns Fuel Fresh Sell-Off in Global Stocks." So this is going to focus more on the global impact, specifically in this case, the global stocks. One observation that stood out, especially in the beginning of the spread of the coronavirus, is that um, it truly shows how dependent global economies are on each other due to the effect that the stock markets had continuously. So, one example of that is the Nikkei 225 index in Japan. From February 25th, it dropped from 22,605.16,450. As of during that same period, well, SX 200 dropped from 127.78 points to 96.95 points. And in that same period as well, South Korea's KOSPI index also dropped from 2,103 points to 1,591 points. And each basically dropping around 24% during that period. And so it just goes to show that around this period, especially in the beginning of the spread of the coronavirus, that it truly shows how economies are dependent on each other, and that if one country suffers greatly, many of its allies will also suffer as well. And in addition to the stocks, the 10-year Treasury note yield dropped to an all-time low of from 1.88 in the beginning of the year to 0.64 as of the beginning of May. And so it seems that the economy is slowly recovering, but we have yet to see if the coronavirus will become even worse. And in addition to that continuing effects, as a result of the coronavirus, volatility of the markets have also increased, which can be viewed as a positive and a negative. For long-term investors, this could be a case of causing panic, which could result in many investors to sell. However, in the case of day traders, people that trade very quickly in a matter of minutes or hours, this presents an opportunity to make quick money. And so it's just a matter of perspective. And in addition to that, if everybody's been paying attention to the news, U.S. crude oil prices tumbled below $50 a barrel. And as of April 21st, it came to the point where prices were negative for the first time in history, which meant that oil producers were paying people, right? They were paying people to take the oil from their hands due to the expense that it had on, to maintain the oil, and it just became too expensive to maintain. So this pandemic, this coronavirus has really exploited a lot of things. One positive, however, in terms of currency, is that as of February 25th, the dollar has risen 2.8% in its strength against other currencies. I haven't, that was based on the article, the time that it was written. However, it'd be interesting to see what was the growth of it as of today, as of May. The long term, global, this is the second article. So also talking about the pandemic, but it's more talking about the specific aspects of economies. And so it was titled Global Growth to Slow Sharply as Virus Takes Heavy Toll. So the OECD stands for the Organization for Economic Cooperation and Development. And so this article was written around beginning of February, early March as well. Basically, this organization, it predicted that the global economy will decrease from 2.9% growth rate to 2.4%, which in dollars is $400 billion loss. It'd be interesting to see as well if they've changed that figure due to an increase of the amount of casualties. And so, yeah, that would be interesting to see. My opinion was that at the time, it was an optimistic prediction due to the lack of knowledge that we have of the virus currently as well. In the case of China specifically, this organization, the OECD, predicted that the growth rate will decrease from 5.7% to 4.9%. However, looking forward, it says that in 2021, growth rate will increase from 5.5% to 6.4%. It didn't really mention in the article what factors led to it making that decision in 2021. However, I feel as if that's too optimistic as well, because there's so much as of today. So it's definitely, in my opinion, it's an optimistic projection. The long term. So in terms of the U.S. factory sector, Institute for Supply Management said that the manufacturing index decreased from 50.9 to 50.1. And just to give a little bit of context, anything below a 50 would display contraction in the manufacturing sector. And so even though it's still slightly above 50, if this trend in the decrease continues, it would have a devastating impact on the economy. And so I guess a question for everyone and some that everybody here could think about is, will this be a long-term or short-term issue? It all depends on the progress that we make against this pandemic. And in addition to that, in China, their own version of the Institute of Supply Management, the Purchasing Managers Index, which measures manufacturing activity, it also decreased from 50.1 to 40.3 in January. And this, like I said, this common theme of dependency within global economies, as a result of the manufacturing activity declining in China, it's also had a ripple effect in countries such as Japan, South Korea, Malaysia, etc. And so it just goes to show that economies really depend on each other. And in situations like these, we see the results. In addition to the long-term, more specific examples, Chinese tourism, in the beginning, I believe it's slowly, progressing now, but in Australia. And in addition to that, due to the economic restrictions that China had originally placed in the beginning, the making of Chinese parts for products such as computers, pharmaceuticals, and such decreased. And so even though, as we mentioned, it's slightly recovering as of today, will the impacted countries, the allies, will they recover? Will China's economy return to how it was pre-pandemic? That's a question that we could all think about. The OECD also predicted that the U.S. GDP would suffer a small decrease in growth from 2% to 1.9% in the best case, right? And in the case of Italy, one of the countries that suffered many devastating losses in the beginning of the coronavirus, the prediction that was given to it was that it would not have any growth in terms of GDP at all, and rather would have a decrease of 0.4%. However, similar to China, it was also predicted to have growth in 2021. And again, this article was written early March, late February. So obviously these predictions were in the best case scenario. They don't have the information that we currently have today. And I believe that if given the information today, they would have probably changed their predictions a little bit. And so this is the third and final article that I chose. It's an emphasis on currency. So coronavirus delivers jolt to sleepy currency markets. So this is going to be focusing on global currencies and such. As of March 3rd, the CBOE / the CME FX Euro Volatility Index, which is a measure of the expected activity in the futures market of the dollar euro, rose 30% in a week as of March 20th, which rose to a high of 18.06 points, the highest since 2015. And in China, implied volatility in dollar yen futures has risen 71% as of March 3rd, 2020. And again, this theme of dependency, Japan, an ally of China, the yen has on average swung 0.24% against the dollar. However, since February, it has swung 42% against the dollar. So the volatility that we have seen in the stock market is also evident. It's also clear in the currency market. So the question that was brought up, or the question that I guess all of us would be thinking about when we see this, is why is there an increase in volatility in the currency market? And so one of the reasons that was brought up was because the Federal Reserve keeps lowering the borrowing cost as a result of the pandemic. As of March 3rd, it cut its target interest rate by 0.5 percentage point. And so explaining this a little bit further, the difference in borrowing costs, according to the article, decides moves in the currency market due to money managers wanting to seek the greatest return on their investments. And so lower volatility in general is more common in the previous years when there's stable interest rates. But as a result of this pandemic, the uncertainty, as we put it, the potential central bank rate cuts that could come with it, it presents an opportunity to investors that want to take advantage of the gap that is between global currencies. It might be shrinking as a result of the pandemic, which, like I said, is an opportunity, an economic opportunity for investors of currency to take advantage of. And so I believe that this is the last slide. Due to the uncertainty of the gap between the rates set by several central banks, option sellers have pushed up the price of insuring against currency moves, which again is another reason for an increase in volatility. In comparison to the stock market, however, the currency market is less volatile. So, and just to prove that, as of March 3rd, the CBOE Volatility Index, which measures the turbulence of U.S. equities, has risen 135%. So I guess the final question for everyone is, would you prefer investing in the currency market or the stock market? It's just a matter of perspective at the end of the day. Yeah, and so that's it, Professor.
Oh, thank you, Ahmed. If you press exit, can you switch me back to the host?
Yeah, sure. I got it.
Thank you. Yeah. Okay, so thanks for Mohammed share us with his summary for the 3 articles in the Wall Street Journal articles, right? So his topic is about pandemic, right? So even these 3 articles are on the early break of the coronavirus in the USA, but I think these 3 articles can give you some implications for our current situations. As you know, right? For today's market, right, actually it's not very well, right, because last Friday, right, our unemployment rate now is actually the highest during the past 2 decades, right. More than 20% of the people unemployed, right, in this special time. So we can expecting if you happen to graduate this year, right, job market will be very tough. And also many companies now are trying to lay off employees, right? But good things is the government, send a check to every household, right? And if you go to the New Jersey, you can see some household even use the check, right, to buy something new, right? If you go to a dealer, right, car dealer, now the car is very cheap, right? And they offer 6 years 0 interest package, right? So means if you buy the car, use the finance, you pay no interest for this special time, right? So many household, right, when they get a new check, they actually trade in the old car and buy a new car, right? So this is a kind of help the economies to do what more consumption. But the problem is unemployment rate can still maintain high for the next few months, right? So even for short term, right, this stimulus package can stimulate people to do more consumption. But in a long term, right, if we not can get employed again, right, or there's no more job offering available, right, economy can be still struggling, right? So that's why so many states consider to reopen. Until today, right, there are 30 states reopened, right? Also, New York City will try to reopen in a June, right? So according to the plan, right, they will open on a June. So we expecting all state will reopen next month. So the purpose to reopen the state, of course, is for economy, right? To open a factory, right? You see that Elon Musk are so mad this week, right? He complained about California government, right, for not allow him to reopen his factory. And also some people in the Michigan, right, in the Texas, right, they do the parade, right, to asking government to reopen as their, parade, right, then all these factory reopened, but it's not the same as the New York and the New Jersey, right? Our factory are still closed because we have more people that get from confirmed with the virus and also more fatality than the other states, right? So that can be a potential risk, right? If we open earlier, right? Actually, all these 30 states not meet the criteria under CDC, right? CDC asking, if you have the confirmed case continue going down for the past 14 days, then you can reopen your economy. No one state meet these criteria, but they still opened, right? So for all these 30 states, they never meet these criteria, but they opened, right? We are not sure New York will have the same situation or not. So there are potential risks. The virus can still emerge again in the winter, right? According to the Morgan Stanley, models I showed last class, right? The virus can be, recovering, right, in a November's, right, causing more fatalities, right? So if you guys, right, will go to the, working place, and just make sure you will still keep distance, right, with the people, right, to protect yourself with the coronavirus. And also for economy, right, you can see from the Hamid, some summary, right? He shows something happened in both U.S. market and also in a global market, right? And you can see our stock in the last month, right, still, lost more than 20%, right, than the beginning of the year. But since the last week, right, many companies go up very quickly, right, including some popular stock like the Apple, right, like the Amazon, right, and also Tesla and Zoom, right. These popular picks, right, are all going up quickly. Seems like most people and most company after they receiving the benefits from the government, right, how they spend the money, right, about 80% of the money actually flow into what financial markets by investing into a company and stocks. Right? So you can imagine that, right? Why the stock market can continue goes up, because once the Trump government, right, release the stimulus package, right, after company receive the money, after household raise the money, how they spend money, according to data, right, 80% of the money actually goes toward stock market. Right? That's why the stock market continue goes up, right? But our real industry, right, our manufacturing actually got hurt a lot, right? It's different situation compared with the financial markets, right? So since the last week, right, many students, right, many of my colleagues, right, continue to discuss, right, which stock was to host for long term, right, in such situations, right? Because for the real industry, for the manufacturing sector, right, no good return can be generated, right? So only possible investment right now, right, to spend your money is potential spot financial market, right? So I hope you guys, if you have some, savings, right, don't buy something unnecessary. Right? You can consider to do some, small investment gradually, right, for long term, right? I think you can realize a good return, right, like what happened in 2008. Now let me share the screen with our final reviews, right? Let me open our final reviews, right? So let's do this review together, right? Now you should see the question, right? So in this final review, we will do some questions together, right? Some questions is from our homework, right? Some questions maybe you already see in a previous homework and in class examples. But we will still see these questions in our final exams, right, in the multiple choice questions. So please do these questions at home, right? So make sure you will handle this question well. First one is about what? About zero coupon bond. So I see one student sent me a message in the chat, right? But let me check, what's the message he put. Okay, so in the chat, I cannot see your message. Can you type again? I cannot see your message. Right? If you have any message, let me know. What is going to be on the final exam? I mentioned this one in the beginning of the class, right? With the details, right? What chapter will cover and what question type you will see, and also which chapters will be the most important for the final review. Please check the beginning of the class. We have the message delivered, right, in the chat for everyone. Right, if you happen to come here later, right, after our, class hour. So here I copy the message, right, again. So let me check, can I copy the message? For the final paper, right, it's optional. So if you want to do the final paper, right, I will create a special link for you guys, right, but it's optional. So why I don't post the link? Because I don't want the other student get confused, right? It's optional. Or I cannot copy the message at the beginning of the class, right, to the chat. You can check the message I show in the beginning of the chat, right? So I also give you details, right, what you need to study, right, for the final exam. For the Shina, right? So I will post a link for the final paper, right? If you already finished the final paper, you can post, right, to the link in the homework assignment folder. Thank you. Now let's go back to our reviews. So you can see the first one is about what? About bond. And for the bond questions in the final, right, be careful. We will most likely have what? Two currency for the what? For the bond questions, right? Because our semesters we focus on the foreign exchange. right? So you should also focus on review with the questions with what? With more than one currency, right? In the bond questions. For example, like this one, right? Zero coupon British pound promise to pay what? 100,000 pound in 5 years. The current exchange rate is $2 per pound, and inflation is forecast at what? 3% in the US, 2% in the UK, and also approximate discount rate for a bond of this risk would be 10% if paid in what? In dollars. Be careful, here discount rate is in a term of what? US dollars. You don't know what's the discount rate in the what? In the term of the pound yet, right? The question asks you what? What's the approximate? What's the appropriate right, price of the bond? Be careful, right? The bond is what? Is in a British, right? So everything must be in what? In a pound, but not in the US, right? Including what? Including the coupon, right? Including the discount rate, right? Everything must be in a pound term, right? If you say something in a US dollar terms, you must to transfer everything into what? To the British pound. So first you can see here, right? What's the future values for this pound you will receive? It's 100,000 what? Pound, right? That's you can receive in what? In 5 years. Right? That's a zero coupon bond, right? So there's no what? That's no payment, right? The payment will be zero, right? You know we have the zero coupon bond means you have no payment of what? Coupon every year. And the question asks you to solve the price for the bond, right? So basically you solve what? You solve the price and the values. But you know you need actually to get what? You need to get a discount rate first, right? So what is the discount rate is the key for these questions. That I mentioned before, right? You know discount rate in the dollars, right? But you don't know the discount rate for the British pound. So that's the tricky part for these questions to solve before you can solve the price of the bond, right? How to solve the discount rate of pound? We use our what? We use our purchasing power parities and the interest rate parities, right? As you know, we have the 1 plus inflation rate, the ratio between the two countries are equal to what? 1 plus interest rate ratio forward for the two countries, right? So we have the 1 plus US inflation rate over 1 plus UK inflation rate will equal to 1 plus discount rate in US dollars over 1 plus discount rate forward for British pound, right? So this equation help us to solve the discount rate inward in a British pound. That's important numbers you must to get to solve to solve the PV of the pound, right? After you solve this discount rate, right, you will use this 8.93 as what? Discount rate, right? And 0 as the payment. You will solve what? You will solve the price and the values. You discount what you can receive in the 5th year, right? For the face value payment for this bond. Use our relevant discount rate, right? That's the price you should solve for this question. So this question is very classical, right? Including the two parities we studied in the chapter 7, or chapter 6, right? And also including what? Including the pound questions in the chapter 12. So you will guaranteed, right? You will see the similar questions for this one in the final. You must know how to solve this one, right? So first you will depend on this parity, right? To solve our discount rate. Then use discount rate, right? To solve what? To solve the relevant bond price. Right? So you can see that's my step on a financial calculator, right? Just be careful. Our interest rate should be what? Should be without percentage, right? So if you solve the 0.08 8.93%, right? So when you when you try to input this one to the calculators, will be what? 8.93, right? Not with what? Not with this percentage, but you need to what? You need to put what? 8.93, right? This is 8.93%, right? So that's the number you should put here, right? 8.93. Right? If you use these calculations on Excel sheet, not use financial calculators, right? Then you will use what? PV functions, right? And in the PV functions, right, you need to input what? You need to input future value, right? That's the word 100,000. And also rate. What's the discount rate? Be careful. Now you need to put a percentage, right? So that's 8.93%, right? And what's the number of what? Period is what? 5, right? And also you need to input the odd numbers if you want, right? For example, right? There's no payment, so 0 as what? 0 as the payment. And also you will pay the money at the end of what? Year, right? So will be the payment tab will be 0, right? So after you input all these numbers right into a PV function, you can also use Excel to solve this price. Both way will be okay, right? Depends on what you like. You can choose either way to solve the present values, right? For some students, they don't like use what? They don't use the software, or they don't use what? Financial calculator. They will prefer to use the formula, right? The formula is also can be solved by use the PV equal to what? Future value divided by 1 plus R raised to the T, right? So future value is what? 100,000. Our discount rate is what? 8.93%, right? Raised to the power 5. You can also solve what? Present values, right? So you can use either way to solve it, right? And for only a few students, right? Maybe you use what? Use the our tables, right? Some students like using the tables, right? In a PV, right? Tables, right? In appendix of the book, right? You may check the discounting factor for this one, right? Use 100,000 to over discounting factor to solve the PV, right? So either way will be fine, right? Our test will be in multiple choice, but make sure you're understanding how to solve this question is very important, right? We will use our parity to solve our discount rate into our what? Domestic currency, right? Then use our bond, calculations, right, to solve the price. So if you have any questions, please stop me, right? This is our final review, right? So I hope you can solve every questions based on your current understanding, right? So you don't need to take extra time to study for this type of questions in the future, right? And also if you see any formula, it is useful, right? Please write this formula down. So next questions, you see this question actually a few times in class, right? So I will not go to the detail, right? Basically, when you solve return for an investment, right, you also consider about what? About the currency exchange rates change, right? If the currency happen to appreciate, right, for investment in a foreign country, you will also add this return, right, for the appreciation of the currency into your return calculations. And so I will not go to the detail for this calculation again, right? But I will help you to review this formula, right? Our returns, including a part for the price change, right? In the domestic currency, that's a PT minus 1 over PT, right? So if you have the background noise, please mute yourself. Right? Please mute yourself. Right? If you have the background noise, please mute yourself. And we have the PT minus 1 over PT. That's the price change in the domestic currency. Right? That's the first part of the return comes from. And also you have the return from what? From the currency's appreciation. Right? if you investing in the foreign market, right? So you have the EX foreign exchange, right? ET minus 1, right? Over ET. Be careful, this ET here, right, is the currency's exchange rate change. So when you solve this return for these methods, right, for this course, don't forget what this part, right, or the currency part. That's the special part for this course, right? I hope you can be very cautious when you solve the questions in this test. Right, in this test. Okay, so if you have any questions, let me know, right? So you can either type in the chat or talk to me directly, right? Next one, you will see, the questions will be also in the final is what? Floating rate note. For floating rate note, right? We see this one when we study the bond market and also when we study the financial derivative market. We both say the floating rate, right? What's the floating means? Means your interest rate will be floating with what? With a LIBOR rate. LIBOR is a reference rate for the interest, right? For the London Interbank, right? Borrowing rate. And this London Interbank offering rate, right, is a reference rate you will refer, right, as your loan or note. Right? For example, this coupon for this FRN will be referenced to the 3 months what? LIBOR. And you see the note also pay the coupon quarterly. Quarterly means every 3 months. So basically, your 3 months coupon rate will be indexed on what? On the 3 months bond LIBOR, right? Pound LIBOR, assuming the current 3 months LIBOR is 4%. If the risk premium above the LIBOR will be charged for 1/8%. What's the next period coupon payment on a face value $1,000, right? At £1,000, what's the payment of the coupon? For the LIBOR, right, we study this one when we study what? When we study the, forward rate agreement. Right, we actually go to detail for this one. Right, first one we know the LIBOR is our what? Is our annual rate. Right, it's our annualized rate. Second, this one is our what? This one is not a discount rate, but add-on rate. So what you borrowed, right, is what you will get from your what, applications, right? This one is charged additional and will not discount what value you will receive from your application. So this two is very important. So if you offered any rate in the questions, right, for LIBOR, it is an annualized rate, right? But if you see the term is quarterly or monthly, you want to match with your what? Time period, right? For example, this is a LIBOR rate, right? It's 4%, but you see the coupons paid what? Every 3 months. So this 4% must over what? Over 4, right? There are 3 months in 1 year, right? That's a 12 over 3 equal to 4, right? And also you see the bank will also charge a risk premium above the level. So this premium is also in the annualized rate. So will be 4 plus 1/8 percent, right? Both will be in percent, right? And this annualized rate will divide by 4 is the quarterly rate. Quarterly rate times the face value is what? Is the coupon payment amount, right? Face value is what? 1,000, right? So 1,000 times by our quarterly, right? Quarterly coupon rate, right? That's the 4 plus 1/8%. That's the 4.125% over 4, right? That will be the quarterly coupon amount, right? So we have the 250, right, times by this rate, right, will be the quarterly coupon amount. Question 9, right, is also a bond questions, right, with the two currency, right? So you can also, study these questions, right, to get familiar with how to do the valuation of the bond, right? And also you can see we have what equity warrant. Equity warrant is very important, right? What that means? Means if you purchase the bond with an equity warrant, you can have a right to purchase the stock with the price specified in a warrant attached to your equity position. Right? For example, this warrant entitles the bondholder to buy 25 shares of the issuer and £50 per share of the lifetime of the bond. The bond is 30 years zero coupon bond with 1,000 par value and has a yield to maturity for 5%. The price of the bond is 500. What's the value of the warrant? Bond with equity warrants can be viewed as our straight fixed rate bond with additional what? Call options to buy the warrant. It is a special feature, right? So the warrant entitles the bondholder to purchase a certain number of equity shares in the issuer at a pre-stated price in a contract over a predetermined period of time. So first, we will solve the price of the bond based on the questions we have, right? So there are 30 years what coupon and 5% what yield to maturity, right? That's our discount rate. And for zero coupon bond, there's no coupon. And our face value is what? 1,000. You can solve what? The bond values, right? But you see the bond now trading for what? For $500. Why the bond trading higher than the price you solve? Because the bond with our equity warrant. The equity warrant asking a premium for the bond to be served on the market because this is something benefits, right, to the investors, right? So this one will take an additional charge if you purchase this warrant, right? So the warrant value will be the difference between the present value of the bond with the face value, right, on the bond on the market. Right? You can see the bond price is 500. The present value solved should be 231.38. The difference will be the equity values attached to this bond, right? That will be 268.62. Next one's a dual currency bond. Consider a British bond and US dollar dual currency bond, right? So this one, with two underlying currency. One is the British pound, one is the US what? Dollars. It will be paid £581.4 and the maturity for every $1,000 per par value. And the maturity is the exchange rate is 1.9 to 1, right? So the investors will be getting better off or getting worse off, right? If they saw this exchange rate on the market when the bond mature. First, you can solve what? You can solve this exchange rate, right? When they purchase the bond, right? You can see here, right? For £1, right? It's equal to how much dollars will be 1,000 over what? 185.4, right? That's equal to what? $1.72, right? So for a pound, right? Based on this pound, this contract, you actually equivalent to what? $1.72. But in the market, right? When a pound are matured, right? You can see for a pound, you should get what? $1.92, right? You are British what? Investors, right? So which one is better? The investor holding the bond are better off, right? Because what? Because they receive what? They receive the more pound right? They for 1.72 you can get £1, right? But for the market, for $1.92 will get £1. So investor will getting what? Better off. Who will getting worse? The bond issuer will be worse, right? Bond issuer what? Bond issuers supposed to have what? $1.9 for £1 they spend, but now they can only get what? $1.72, right? You can see our bond issuer are what? Are worse off, right? In this what? In this province. Next one is also our floating rate questions, right? But this one is 6 months, so everything will be similar to the last questions, right? But just what? 6 months. And for question 13, right, you will not see these questions in the final, right? But last semesters, we also studied the exchange rate options, right? So these semesters, we will not have the option questions in the final, right? Only thing you need to know, just some, basic interpretation of the option scheme, right? You don't need to solve the price for an option in these semesters, right? So we will ignore these questions. And the next one is forward for the ADR. ADR, we have the two questions in the homework 4, right? One is for the Audi, right? For the Audi, sorry, for the Audi. One's for the Rolls-Royce, right? We actually studied these two questions in the last class, right? So please review these two problems, right? We have ADR questions, right? In the final, make sure you will, review ADR questions, right? And for the forward rate agreement questions will be our important topics, right, in these matters. So you will see more than 3 questions in the final, right? The first questions, you will solve what? You will solve the forward rate, right? You will solve the interest rate. You will solve interest rate, right? How to determine what's the rate you should assign in a contract will be the first problems you will solve in the final. So that's very important, right? That's called pricing of what? FRA. So if you go to FRA chapters, we have special, examples and formulas for the pricing, right? The pricing means the exchange rate, interest rate you will assign in the contract, right? So for example here, based on the market quote on the Canadian dollars level, the 6 months level and 9 months level is 1.5 and 1.75% respectively, right? Assume there's 30 to 360, that's 1 month count convention. Please calculate, right? What's the 6 by 9 FRA? For FRA questions, without to do anything, right? You should draw a chart at beginning, right? So you can see it is the 6-9 months FRA, right? For the first 6 months, it is the period forward for FRA contract. Now on the 6 months, you will check the interest rate on the market with the rate in FRA to say this FRA is beneficial or not. So you will settle down earlier, right? If you really want this loan to happen, then your loan will start from the 6 months to 9 months. So this is for long period, right? Based on these questions, right, in a market we observe, right, the 6 months rate is 1.5, right? 9 months rate is 1.75, right? The longer you borrow, you should charge with higher interest rate because the rates will be higher, right? It makes sense when the numbers here will be bigger, right? So what's the 6 by 9 FRA's rate you should charge for this loan? That's the question asked you to do, right? you can see here, right, as we mentioned before, there are two ways you can borrow the loan for the total 9 months. The first way you will borrow directly, right, for 9 months. What's the charge for interest? Will be 1 plus this principal, right, plus the interest. Interest will be 1.75% over 12. This is 12 months, but you borrow forward only 9 months, right? So you can say this one actually confirm what we mentioned just before, right? About what? About the level is our what? Annual rate, and also it is a add-on rate, right? So our annual rate should be divided by 12, got a monthly rate, right? Monthly rate times the 9 will be the 9 months rate, and it is what add-on rate, right? So you're not like the discounting rate, right? We will times, but we will add on, so that's plus. And this is the first way you directly borrow forward 9 months. Another way you can borrow is what? You borrow 6 months first. Then after 6 months, right, you will continue to borrow what? Next 3 months, right? So 1 plus, that's the rate you want to solve, right? So x over 12 times what? 3. So these two will be what? Equalized, right? That's how you solve what? This FI rate for these 3 months, right? Based on these two, borrow pairs must be equivalent, right? So I don't want you to memorize the formula. Just make sure you're understanding, right? How you solve this rate, use this chart and use these two equations, right? Question 19. Question 19, we will determine, right, who will pay whom, right, in our FIA settlement on 6 months, right? Who will pay whom and how much should be settled? That's the key. That's the problem we should address, right, for this settlement amount here, right? And you can say you will compare FIA rate with the rate on the market on the 6 months, right? See which one's bigger. Then you will determine who will pay this amount. For example, if a settlement rate are higher than contract rate, then our FIA buyers will receive a settlement amount, right? Because what you will pay is less than the rate in the what? In a market, right? So the buyer actually saves the money. So settlement will be paid from the what? From the bank or from the, the lender, right, to the borrowers, right? That's FIA buyers. If the contract rate more than settlement rate, what you signed in the contract even higher than what? Than the market rate, you are charged even higher, right? So you will pay the money to the issuer of the FIA. So for this question, you must to first determine who will make the payment for settlement, then how much it will be settled, right? That's very important, right? And for these questions, we actually show many examples in class and also on the lectures on the on YouTube, right? So please make sure you're understanding these questions on the YouTube for this lecture, right? You can see when you try to solve these questions, first you need to draw this chart, right? Let me show one more examples here. For example, right, a bank bought a 3 against 6 FIA, right? So if you see the number, you will directly draw this draw these 3 to 6 months FIA. And you can see this is the notional face value, right, for the 3 months period, beginning 3 months from today and ending in 6 months. So that's for this period, right? The reason the bank want to buy this FIA was to hedge. The bank, taking the 3 months deposit and make a 6 months zone. The agreement rate was with the seller is 5%. right? That's the contract rate. Assume the 3 months from today, settlement rate is what? 5.25. So 5.25 is more than 5%, right? Means you will pay less than the market. So the holder of FIA will be better off. Who is the holder of FIA? It's the bank. My bank bought this FIA. So bank will what? Getting better off, right? But the seller of FIA will be getting worse off. So the counterparty of the bank will pay the money to the bank. And for how much? You can see here, right? You borrow this money for what? For 3 months. It's only for this period, right? So 3 months is the 3 over what? 12, right? 3 months over 12, right? And what's the interest you can save? You can see that's the difference between these two interest rates, right? 5.25 minus what? 5%, right? And this savings will be delivered on what? On when the contract ends on time 6, right? But once you determine to settle this contract, you will determine what? Settlement on the time 3, right? So this amount will be discounted what? Times 3. Use what? Use discounting factors. 1 plus what? Market rate 5.25, right? Over 12 times what? 3, right? So you can say that's the notional savings you can save, right, from how much you borrowed, right, from the market rate. Now you discount this one to the times 3. Use our discounting factors, right? You solve this amount, right? If you cannot see my handwriting clear, these questions is actually the same questions we covered in class before. Please refer to the chapters FIA for the more details, right, for these questions. Especially we have pre-recorded lectures, right, on the YouTube, right? You can refer to these lectures, right, videos, right, to halt in the middle to see more details, right, for these questions. And if you have anything you're not clear, right, please make sure you double check the video again, right, on YouTube for these questions. There are more than 3 examples, right, on the blackboard, and also on the YouTube channels, right, we have the 3 more examples in these lectures videos, right, to solve these problems. Please make sure you go over all these examples, right, to get some sense for these problems. Do you have any questions? If you have any questions, you can talk to me directly, right? If you talk, you will not mute, right? And also you can type your message, right, in the chat. And let me give you a very famous, hedge fact, right? Hedge examples in the real industry. I think everyone knows the brand Alpha Meal, right? Especially if you have the baby before, right? Or you have the kids, right, in your family. You know the Alpha Meal, right? Alpha Meal is a famous brand for what? Baby formula, right? Do you know who purchased the Alpha Meal, the brand? It's not a irrelevant company, but it's what? It's a Durex what? Condoms company, right? They actually bought what? They bought the Alpha Meal. This is a very good examples in the real world for what? For the hedging. For the hedging. What's the meaning of the hedging? You want to do something, to hedge the downside risk for your business or the company, right? So for the condom companies, right, what's the downside? Suppose the people don't want to control the birds, right? They want to have the more babies, right? Then they don't use what? Condoms, right? So which one will be, popular? Will be what? Baby formulas, right? So you can say that's the reason why the Durex, right, bought a baby formula wood. makers companies, right? Because it will actually hedge the downside of what these companies risk. Right? You can see something funny, right, in the discussion here, right? The Durex purchased a company that makes baby food. They are just covering all the base, right? When a quantum feels right? Smart. I like the move, right? So this is a highlight of the news on 2017, right? And this is a perfect case forward hedging, right? Hedging risk. In our these semesters, we see also many examples to hedge risk. For example, forward rate agreement is a contract to hedge what the interest rate risk, right? And we also study what we also study the swap, right? We also study the forward and the future, and also what options. All these financial derivatives, right, can be used to hedge risk. Or can be used to do some speculations, right? For example, right, I mentioned in the class before, there will be a questions asked you to explain why the oil price is negative, right? In the recent news, why the oil future price can be negative. There was some famous crude oil index in the US, right? Once the WTI crude oil index, right? And you see the WTI future, the price is negative, right? It's minus $30 per barrel, right? In the last month, people are crazy about this price, right? Because the future price will be never negative before for crude oil. Why the price can be negative, right? It's a question you will see in the final, and I explained this one in class before. Because the shipping and the storage cost of the crude oil even more than the price of oil itself. That's cause the what? Cause the people holding the future contract, they willing to shipping the oil away to avoid to receiving this oil. Because if they receive the delivery of the oil, they must to cost what? More, more cost for the transportations and also more cost for the storage, right? It's not even economic, right, to receive the oil in a physical, delivery. So that's why the price is negative. And so that's one question in the final to ask you to, choose the answer for this one. Also, right, you can think about it. Right? So why the people buy the future, buy the options, buy the swap? They want to, protect themselves with some potential risk. For example, in my portfolio's investment, I holding, my current holding is USO, right? The oils ETF, right? I'm very regretful, right? I selling a Tesla 2 weeks ago when the price still cheap, right? If I hold the Tesla now, right, my portfolios will have a great return, right? But I sell the Tesla and then bought some oil ETF, right? I will plan to hold this one for longer term. Suppose I'm also afraid, right, the oil price will continue going down in the next month. What I will do, I will not sell this one, of course, right? Because I'm not certain about price, but I'm sure the price will in the long term will recover. I only want to protect myself with short-term risk, right? So I will not sell this stock. I will not liquidate my stock position, right? However, I can buy some what? I can buy some short-term put options, right, to protect myself with the potential downside risk, right? Downside risk. So that's something about hedging risk and speculations, right? So when we study the derivative, right, in the chapter 7 and chapter 11, we mentioned these two purposes, right? Why we need to buy the derivative, right? One is for the hedging risk, one is for the speculations, right? You want to pay attention to the questions I will give to you, right? In the final, you can determine, right, what's the purpose, right? Why the agent, right, buy this derivative. Right? So that's the review for the final. I don't want to give you too many questions, right? Because the final you should based on our lecture, right?